Good afternoon, everybody. On behalf of Vegan Burger and Winer, we welcome you to our first webinar of the year. So today we have with us Brad Rutan. Brad is an investment product specialist at MFS Investment Management and covers the firm's growth equity investment strategies. He works closely with the portfolio management teams and is responsible for communicating investment philosophy, process, and the position of MFS investment strategies. Brad joined MFS in 2006, and he began his career in the financial services industry in 2004 at Putnam Investments. He holds a charter financial analyst designation from the CFA Institute and is a member of the Boston Securities Analyst Society. And with that, I'm going to go ahead and pass it over to Brad. Brad?
Okay, welcome everyone. Thank you for being patient there. Hopefully, Howard, do you see a title page that says the 5 bull market threats on it?
Yes, I do.
Great. So this has been a very difficult year to begin with, and I know a lot of clients are very concerned right now. I think we need to realize that volatility is back, and what we've gone through the last, say, 5, 6 years is a period where generally volatility was not present in the market, and that's not normal. You should have volatility in the market. That's just part of the game. And I think people are overly concerned about the next big event that's going to come and destroy the market. And it reminds me of a baseball game I was watching back in the summer where my beloved Red Sox, who did not do very well this year, were playing, and one of our young stars, whose name is Brock Holt, was up at bat, and the pitcher wanted to reclaim the plate. And for any baseball fans out there, you know the way you do that is you throw a pitch right at the batter's head. So that's what happened. The kid went down in the dirt, and he got back up, got back in the batter's box, dusted himself off, but he proceeded to watch 3 of the most perfect pitches go right down the pipe. Strike 1, strike 2, strike 3. The bat never left his shoulder. He was obviously rattled, and as I watched it, I thought, that's a pretty good analogy for how investors are looking at the market today. I think they took a headshot with this little correction, or the one back in August, and I think they're waiting for the next pitch to be another headshot, to be something that's going to take out 20, 30% of the market, some horrible event, when in reality we think you should be looking low and away. You should be looking for a strike, because right now the fundamentals of the market are not poor. They're actually quite good. In the 5 reasons that bull markets generally end, are all but 1 maybe are not present. So that's what I want to do today, is I want to go through the 5 reasons, if you go back in history at every sustained bull market, the 5 reasons that bull markets end, and whether we see any of this in today's market. So the first threat would be a recession. And what we're showing you on this chart, that red line is simply the difference in yield you're getting from a 10-year U.S. Treasury and a 1-year U.S. Treasury. So if I was going to loan you money, and I was going to loan you it for a year, and then I loaned Howard money for 10 years, I would expect Howard to pay me a higher rate, a higher yield, because that money is being tied up for a longer period. So you'd expect the 10-year loan to yield more than the 1 year. And what we're showing you on this chart here, anytime that red line goes below 0 and you get that green dot, that means that 1-year loan actually is more expensive than 10 years. So it was more expensive to the person that I loaned money to a year versus one that I loaned for 10 years. It doesn't make sense. But look at the gray bars. Those are recessions going back to World War II. And what we've noticed is that every single recession, every single gray bar, was preceded by that inverted yield curve, by that phenomenon where your 1-year debt costs more than your 10-year debt. It's not normal, but it's also one of the best predictors of an impending recession. If you can look at the far right of this chart, where the data ends, which is at the end of December, we are well above zero, meaning for this to go down below zero and signal another recession, you would need the Federal Reserve to be completely aggressive and just start raising rates without any caution or respect for the actual economy. We don't think this is going to happen. We don't think that this yield curve is going to invert, as we call it, and therefore we don't think that a recession is around the corner. If you don't like the yield curve, if you don't think that it is a good predictor of recessions, on this slide here, we listed a bunch of recessions going back to the 60s, as many as I could fit on the page. And then we added in 5 other indicators that often tell us that a recession is coming around the corner. So if this indicator was telling you that a recession is coming, you get a red X. If that indicator was saying, nope, the economy continues to expand, you get a green check mark. Look at today, present day, down the bottom. What we're seeing is that 3 of these indicators are signaling further expansion, and 3 of them aren't signaling anything. They're neutral. But none of them, 0 for 6, are indicating recession, and we have not had a recession without at least 3 of these indicating recession. So we look at this data and say, yes, the economy isn't great, but it's okay, and we don't feel that we're going into recession. There's something we need to realize about the U.S. economy right now. I'm tired of hearing the narrative on CNBC that this is a sluggish economy, that it's a plow horse economy, because I disagree with that. And the reason is this. Most business cycles begin, the first thing that happens, so you come out of the recession, think back to, say, 2009, and the first thing that happens is companies and consumers load up on debt. So you go out and buy the washing machine you've been waiting on because rates are low. Companies issue a lot of debt and they build a new factory because they can finance it at a low rate. And all of that extra debt and all of that extra spending kind of kickstarts the recovery. You grow very quickly in the beginning, everyone feels good, and you're off to the races. Well, this recovery was different than every other one we've seen, in that at the very early stages, companies and consumers did the exact opposite. They slashed their debt all through the first 5 years of the cycle. So instead of having all that extra debt and spending to boost the economy in the beginning, we had debt taken out of the system, so you didn't have that kickstart at the beginning. But isn't that healthier? Isn't it healthier that we've grown organically, say 2% this entire cycle without the excessive use of debt? So I think it's a healthier recovery because it wasn't front-loaded with debt, and therefore we think it's going to be a longer recovery and don't think that recession's around the corner. All right, so that's number one. Number one threat would be a recession. We don't see that in the cards. Number 2 threat would be if the market's too expensive. Please don't get lost in all the data on this slide. Let me explain what I'm trying to show you. For one, when we look at stocks, we don't care what the price of a stock is. That might sound odd, but we don't care if Apple costs $100, $150, or $700. What we look at is what's called a valuation, or price divided by, say, earnings. That would be that PE that we're showing you there. And the reason is this. If I could sell you 2 Coca-Colas right now, 2 cans of Coke, one of them was $1 and one of them was $2. And I asked you which Coke is more expensive. Well, everyone on the phone would obviously say the $2 Coke is more expensive. But what if I told you that the $1 Coke only had an ounce in the can and the $2 Coke had 150 ounces in the can? I think you'd change your mind, and now you'd say that the $1 Coke is more expensive. Well, that's how we look at stocks. We don't look at the price. That's not important to us. We take the price and we divide it by, say, the earnings, what that company can earn over the next year or so. And that's valuation. That's how we determine if the market's expensive or cheap or whatnot. And what we see today is that when you compare today's valuations to during the tech wreck, which was March of 2000, which was a very, very expensive, overvalued market, today's valuations are nowhere near what they were back in 2000. So middle of the chart, the two columns on the right versus on the left, the PE ratio, forward and operating. So we're nowhere near those levels we saw back in 2000. But when you compare them to October of 07, which was right before the financial crisis, well, now you can make the case maybe we have a problem here, right? They're very similar, above, maybe below, right around the levels we saw back in 07. Well, that's true, but look at the last two rows, cash and debt. Companies today have double the cash that they had back in 07 or 2000 and about 60% of the debt. And we feel that that has to count for something, that companies this healthy from a balance sheet perspective, you should pay a higher price or valuation for those companies. So we don't think that valuations are going to be the reason that this bull market ends. So one was recession, two was if the market's too expensive. The third bull market threat would be inflation. So what we're trying to show you here is the vertical column is that valuation we've been talking about, that price divided by the earnings. And then we listed different levels of inflation, or CPI, in the bottom, and measured under what inflation environments do stocks do best. Well, it's when inflation is low, when it's 0 to 2, followed by 2 to 4%. That's generally when equities do best. When inflation goes out over 4%, that's when equity valuations start to fall. But this is where we're stuck. We're stuck in this 0 to 2% range. And it's quite possible that we're stuck here for an extended amount of time. One thing that causes inflation is wages. So as the unemployment rate comes down and people start earning higher wages, that often translates into higher inflation, and that's not necessarily good for equities. So some of you might be wondering, well, Brad, the unemployment rate has come down to around 5%. So isn't that signaling that we have inflation building in the system? And if there's one thing you take away from this call, and only one thing, it would be this. Please don't look at the unemployment rate anymore. It's a very bad measure for the health of the labor market. When the government issues the unemployment rate, they actually issue 6 of them. The one you see in the news is called U3. That's just the unemployment number 3 rate. Tucked into the very back of the report, last page, is the U6 unemployment rate. Let me tell you why that one is the important one. In the U6 rate, you get counted if you're unemployed, so just like the U3. But you also get counted if you're underemployed. So you're working 20 hours, you'd rather work 40, so you're part-time, not by choice. You get picked up in the U6 unemployment rate. That number is closer to 10.5%. So 10, 11% of Americans are either unemployed or underemployed. Why is that important? Well, as the unemployment rate has dropped, unfortunately or fortunately, however you want to look at it, a lot of the jobs we've brought back are part-time. And part-time workers can't ask for wage increases. Therefore, even though the unemployment rate has dropped, it hasn't created any significant inflation, which would be bad for equities. When we get to Q&A, I'd love to tell you another reason why we could stay in this low inflationary zone, and it has nothing to do with us. It has everything to do with China. But for the sake of time, let me get through the next 2 bull market threats, and we can circle back. I think it's a fascinating story, but let's wait to Q&A if there's any interest on that. All right, so that's number 3, would be high inflation. The 4th reason that bull markets have ended in the past has to do with interest rates. So when interest rates have risen in the past, that's killed bull markets. So when we talk about interest rates, we often refer to the U.S. Treasury rates. So the rate you get when you buy a U.S. Treasury bond. What we're listing here in this graph, again, on the vertical, there's that PE ratio again, that valuation, how we look at the market. And then in the bottom, that's the 10-year Treasury yield. So what's the yield on a 10-year Treasury? So what we've noticed historically is that as the 10-year yield has risen from 2 to 5%, so as rates have risen, that valuation, that PE, rises. It's not until you get over around 5% that as rates continue to rise, that equity multiples contract or they start to fall. But the beginning stages of rates rising historically has been good for equities. And if you asked your advisors, when you thought we'd get to 5% on the 10-year Treasury yield, or if you thought that would happen this year, you'd probably get a chuckle out of them, because it's about the least likely scenario out of anything that we get anywhere close to 5% on the 10-year Treasury this year, or probably even next year. So we don't think that rising rates will be bad for equities until we get over the hump of around 5%. All right, that was number 4. Those 4 threats we don't view as present in the market today. The 5th threat is something that keeps us up a little more at night. And the 5th threat is geopolitical, or something exogenous, something that's not really related to investing or the markets. So think, I listed a few here, but think Putin in the Ukraine. Think of ISIS. Think of what happened in Greece the last few years. Think of 9/11. So something that happened where it caused a great deal of emotion in the market, but it wasn't fundamental in nature. It's very tough to model these outcomes into your investment decisions. I mean, how do you gauge your investments based on what you think Putin is going to do or ISIS is going to do? You really can't. The silver lining is this, that historically when it has been a geopolitical event that was the bull market threat, it's usually very quick. So the market corrects quickly. It goes down, violently or dramatically, but then you get back to business very quickly afterwards. And I think 9/11 is a great example. Everybody remembers the devastation we saw on American soil, and everybody remembers the markets falling apart. What most people don't remember is that within 30 days, 1 month, we were actually back to the highs that we had on the day before, on September 10th. So the market corrected violently, but within 30 days we were back to highs again, because it wasn't fundamental in nature. There was nothing different about Colgate or Coca-Cola or Home Depot. There's nothing different about their earnings or their debt or their business model. So you get back to business pretty quickly. But this is the one, there's a lot going on in the world right now that we give pause to as there's much going on in the world. So those are the 5 bull market threats. Recession, overvaluation or expensive markets, high inflation, rising rates, and then the 5th would be geopolitical or exogenous. I will make this statement, and it's something that I truly believe. This is the most hated bull market in bull market history. And I'll say it again. This is the most hated bull market ever. And the reason I say that is this, that we're 7 years almost into this bull market. And along the road of these 7 years, investors in general never really believed in the bull market. All of the money has gone into bonds. Very little has gone into equities comparative to bonds. We're actually still net negative. For all the money that came out of the market in '08, we haven't really even gotten back to positive. the bullishness, the percent of people that are bullish in the market has never been lower than in the last 25 years. It's a hated bull market, and hated bull markets are long bull markets, because bull markets usually end when everybody's enthused and everybody wants to get into stocks, and that usually precludes the end of it. But as we sit today, it's truly a hated bull market, and personally I'm glad it is, because that just gives those that are invested in the market the advantage. So I'm going to end my prepared comments right there. That was about 20 minutes on the dot, and I'd love to, I know there's some polls that were taken, and hopefully there's some questions. Nothing is off limits. I'd love to hear what's on your minds. We have all this great data and access to information, but in the end, you're the investor, and we'd love to hear what you're thinking about, what concerns you. So let me end there and see if we can get some questions.
Thank you very much, Brad. Very good insight for sure. So again, if you want to ask questions, we're going to ask that you email. For compliance purposes, we have to track these. So if you wouldn't mind emailing any questions that you have to Danosos, that's DANOSOS @ebwllc.com, and put the 5 bull market threats as the subject. We'll go ahead and get your questions answered. So Brad, I'm going to go ahead and start the questions off if you don't mind.
Sure, that's great.
So first off, we launched a poll that talked about Dalbar, and it asked about what has the most impact on investment results, and 83% of our respondents here said investor behavior. Do you mind talking real quickly about that?
Yep. Well, you obviously have a intelligent or informed client base, because that's correct. It's investment behavior. So the last 30 years, the average investor return in U.S. stocks was 3.7% annually. That's the average investor return. Whereas the S&P 500 over those 30 years averaged 11.1%. So 3 times higher than the actual investor experience or the actual investor return. And the main cause, it's investor behavior. So, what do? Well, a fund or a stock was really hot last year, so you want to get into it. So then you buy it after it had a great year. So you bought it at a high. And then the market volatility returns, and people are nervous, and what do? They sell. So then they sold low. I mean, we're supposed to buy low and sell high, but most investors, because of emotions, do the exact opposite. Think of it, a train ride from Chicago to San Francisco. That's 2,438 miles. I know that because I've taken it. But only the people that get on in Chicago and get off in San Francisco actually log 2,438 miles. A lot of people will get on in, say, Denver and ride the rest of the train. So they didn't get the full 2,438. Some of them maybe got off in Omaha, rode from Chicago to Omaha. So again, only the ones that ride the entire train get that full mileage. It's the same in investments. Only those that actually stay in their investments and add to it when markets are down get the full benefit of returns. This is the reason why our company will not sell you our funds directly. You cannot buy our funds through us. You have to buy them through an advisor. We'd probably be a lot bigger today if we didn't make that decision, but that's how important we find that relationship, because it's the advisor that can keep you steady, that can help you through these tough times that we're experiencing now, and not sell out at a low or buy at a high. And so hopefully that gave you some good perspective.
Yeah, I think that was very good. Thank you very much for explaining that. So we do have a couple of questions here. The first one is asking about the effect of a stronger U.S. dollar on our economy as well as the global economy.
Yeah, it's obviously the greenback, the dollar, has increased in value. where we've been the best economy and best markets really in the world in the last few years, so a lot of money has come over here, and that's pushed the value of the dollar up versus other currencies, and people think, that's troubling for the economy, that's troubling for the stock market. Well, in actuality, we measured the correlation, the relationship between the dollar and GDP, so the economy, between the dollar and corporate profits, and the dollar and equity returns. And the correlation is absolutely as close to zero as you can get. It's like 0.002, 0.001, depending on the chart. We have the most diverse economy in the world, bar none, the most diverse. So a strong dollar is going to hurt a couple companies, it's going to hurt a couple sectors, but it's also going to help some sectors and stocks. And the net effect gets muted out. So as long as you're diversified, and you're not just betting it all on a couple companies, the strong dollar should not have overly negative effects.
Okay, very good. The next question was inquiring about oil and what's going on with oil and why does the stock market seem to follow the price of oil?
Yeah, it's irrational to say the least, especially when you have transportation stocks. So think airline stocks. What do you think the number one cost of an airline is? Well, it is emphatically oil. It's fuel. So a drop in oil should help an airline, and yet airline stocks have been trading off too. So there's definitely some irrationality, or I don't know if that's a word, irrational behavior in the market right now. But we don't think that oil is going anywhere north anytime soon. It's probably range bound somewhere between 30, 50, who knows, but it's not going to go north to 100 again. And all the benefits of lower oil will start to bleed through the economy and companies. Most companies, the reason you haven't seen the immediate effect on company profits is they hedge out their energy exposure, say a year in advance. So what they do is they use derivatives to lock in the price of their oil. So let's say that I'm an airline, and I'm worried that oil is going to go up to $200 a barrel, so I use these contracts to lock in the price of my oil, say at 120. Then I'm protected against any rise in oil. Well, all these companies are hedged out through 2016 or through 15 at least. So as all this hedging rolls off, you'll start to see them redeploy new hedges, and they'll get to benefit from lower oil. So we think lower oil will help companies and consumers this year. It just hasn't yet.
Okay, so I recently saw an article that said that the lower oil prices are going to essentially give every U.S. consumer about $700 back this year. So hopefully we'll see them start doing some spending and some wise choices with that money.
Exactly.
Do you think the oil glut, is that a demand issue in that economies just don't need as much oil, or is it more of a supply issue where everybody's just producing more oil than we need?
Yeah, well, demand has an effect, i.e. the U.S. has been only the real grower for the past 5-6 years. It's really a supply issue. OPEC is struggling with the new kid in the block, which is the U.S. With fracking and all the energy exploration in the U.S. We've become a huge energy producer, and kind of disrupted the balance that OPEC had for years. So all of our oil has come on the market. At the same time, OPEC has decided not to cut production. Usually when oil prices fall, OPEC cuts production to protect the price. But this time they decided not to, because they want to squeeze American companies out of the market. They want to make them go bankrupt. So you've seen tremendous supply come on the market, and that's had an effect on lower oil prices.
Okay, so that tends to kind of support the opinion that the global economy is not necessarily slowing, as we're still demanding about the same amount of oil that we have been, at least on that same trend line, for quite some time.
Correct.
Good. All right, so next question here is about the Fed. Will the Fed lower interest rates, perhaps even go negative? And what impact do you see from the Fed's decisions?
Yep. For one, the big reason that the market's down this year is some, I'll choose my words wisely, I'll just say a couple Fed officials came out with a very, very ignorant statement, if you could allow me to say that.
You're among friends. Go ahead.
That they were going to hike rates 4 times this year. And that was very irresponsible of him to say that, because there's no way this economy can support 4 Fed hikes. And the market has really had a hard time with that statement. He's since walked it back, or the Fed has walked it back, kind of detracted that statement. But I don't think the Fed will go negative. I think their credibility would be shot, but I don't expect them to raise 4 times, at most 2 times, and I think equally as likely is a cut back down to 0. That's really the reason they raised rates, was so that they had a bullet in the gun, if you would, that they could fire at the economy if they needed to. That's really the only real reason they did it. But generally, when Fed hikes are slow and measured, that's been very good for the equity market. So if we can get to a normalized slow path, which I believe is the plan of the Fed, historically equities have done very well. When it's been quick, so the Fed hikes every meeting, that hasn't been great for equities. But we think, and hence why it's sold off this year, but we think they're going to be a very slow and measured path that's been very good for equities historically.
Okay. And they've always said that they've been, that they're very data dependent, I think was the term that they often used.
Correct. And the data sure does not support any hikes really right now.
Okay, good. All right, so next question we have is on China. What's going on in China, and how will their fiscal policy potentially affect the U.S.?
Yep, there's a saying that Chinese pain equals U.S. gain. And let me walk you through that. So we don't think that the slowdown in China is a negative for the U.S. We think it's a positive. But could we please put their slowdown in perspective? They're slowing down to a growth rate that's triple what the U.S. is growing. So it's not like China's going into recession. They're slowing down to, say, 6%. That's triple what the U.S. economy is doing. So I think you need to really put that in perspective. It's not like they're falling off the map. But China has built their economy on something called investment. So half of their economy is building roads, building bridges, building cities. And that's, in the history of the world, has never been done, ever. Has an economy had half driven by investment. The U.S. economy, 3/4 almost, is consumption. So what you buy drives our economy. What they've done for years to keep people employed and keep them from protesting is they've built stuff. So ghost cities all over the country where they build a city that can house 1 million people and there's absolutely nobody living there. If they needed a road to an airport, they built 6 of them. If they needed a factory, they built 2 of them. This is what has driven this unbelievable growth in China the last couple of decades. It wasn't because they were buying things or exporting things, they were investing. And they've finally realized they can't continue to do this anymore. And they're trying to push that investment down and drive up consumption. Very, very hard thing to do, and it's going to take a decade for them to complete it. So you're going to see slower growth out of China as they kind of decrease the amount of investment they do. They can't keep doing it. So there's the Chinese pain part, slower growth. The U.S. gain part comes from the fact that they are the biggest consumer of commodities in the world. 50% roughly of all cotton, coal, steel is consumed in China. About 1/4 of all food and energy is consumed in China. So when they slow down, what happens is commodity prices fall, energy prices fall, steel prices fall because there's not as much demand. And what happens is the U.S. gets low inflation. They've been exporting low inflation to us since 2013, and they will continue to do so as they slow. That's good for equities. We saw that earlier in the presentation, and it's very good for the economy because our economy is built on buying things. So we don't think it's a bad thing. It just makes for good headlines in the news. but overall it should be a good thing.
Okay. Yeah, I also saw a statistic, and you can let me know if this is correct, but China essentially purchases from, Chinese purchases from U.S. manufacturers account for less than 1% of our GDP.
You nailed it. 0.7%, not even 1%. Spot on how it's such a small part. Even if China did fall off the map and went away completely, the hit to U.S. exports would be de minimis.
Okay, and on the flip side, obviously, we buy a lot more from China. So again, that should be a net positive for us.
Yep, because the imports would be cheaper.
Yep, very good. So next question is on the election. So who's going to get elected?
Howard Pressman, of course.
Oh, there. Yeah, I don't think anybody would vote for me. Nor would anybody want that. But the question really, though, is what is the impact of the U.S. election, and can a change in leadership in the country affect the bull?
Yeah, I think it could definitely introduce some volatility. But what drives stock prices are earnings, cash flows, profits. That's what drives stock prices. Who's in the White House does not. It will over a very short period of time. So maybe, let's say, Trump or Sanders got elected. You'd probably see some volatility in the market around the election. But 3 years from now, what Apple can earn in earnings and what they're going to pay out in a dividend will have no bearing on that. It's noise. It's fodder for CNBC and Bloomberg, but in the end, when we're modeling out companies and figuring out what to put in your portfolios, that's just not important to us. Maybe on the margin, it might affect, say, energy companies or medical device companies, but it's something that we don't put much faith in. If anything, we use it as an opportunity to buy more of stuff that sold off because of the elections.
Okay, very good. So the last question that we have is on inflation, and it was referring back to some comments you had made earlier in your presentation.
Yep. I think the comments I was making was about China, the fact that the slowdown in China. So we talked about wages not creating inflation because a lot of the jobs come back are part-time. I just talked about China, the fact that the slowdown in China is in effect putting a cap on how much inflation we do get because commodity prices are lower. And I guess the last thing would be money supply. So a driver of inflation is money. So what the Fed has done by dropping buckets of money on the economy, most people think, oh, that has to be inflationary. That's going to create inflation. Well, the amount of money in the economy in and of itself doesn't create inflation. For example, everybody on the line today, let's say we could create $1 trillion right now with a magic wand. So we just create $1 trillion, but we take that money and we lock it up in a closet and throw away the key. How much inflation did that $1 trillion create? The answer is 0.000. It only creates inflation when that money gets out into the economy and starts to move around. And it's what we call velocity. So how quickly money moves around. I go buy a car, the dealership pays its workers, the workers go out to eat, the restaurant buys more food, and the quickness of those transactions, that creates inflation, not the amount of money. And that velocity or quickness has been dropping for years, so it really hasn't created any inflation. So, we're just in a low inflationary period that's very good for equities in the economy.
Okay, very good. Well, according to our last poll, 83% of the folks on this call have said that this presentation did help them feel more comfortable about the economic and market events. So clearly you've done an outstanding job, Brad, and I thank you very much for that.
Well, thanks for your time, and that gives you an opportunity to work with the other 17%.
Yeah, well, very good. Thank you. So future webinars that we're going to be having this year, we're going to look at long-term care insurance and healthcare costs. So that's going to be an interesting one. That's something that a lot of our clients have indicated that they have an interest in. We're also going to have a presentation on property and casualty insurance. So this will specifically focus on homeowners insurance, liability insurance, automobile insurance, and perhaps some of the risks that you may face there. And then also we're going to have a presentation for the younger people in your lives, those who are just getting ready, perhaps to start saving for retirement, just graduated, but this one is called Don't Let a Cup of Coffee Cost You Your Retirement. So be on the lookout for future announcements of those webinars and presentations. I thank you all very much for your time today. I hope that you found our presentation helpful. And of course, any questions that you have, feel free to reach out to your advisor here at EBW. We're always excited to have nice conversations and answer any questions that you have. As always, I thank you for your trust and confidence and look forward to talking with you soon. Thank you very much and have a great, great day.